Every day, you use money without thinking about what it actually is. And that blind spot quietly changes how you save, spend, and lose wealth. You are standing in a supermarket line, basket in one hand, phone in the other. The cashier scans bread, milk, eggs, and a few apples. You tap your card, a small beep. The receipt slides out. You tuck it away and walk home. That moment feels completely ordinary. It is not. You just handed over numbers on a screen, and someone gave you food in return. Nobody asked whether you grew the wheat, raised the chickens, or picked the apples. Nobody needed to know you personally. The trade worked because both sides trusted something invisible. And that is the part most people never stop to notice. Money is not coins and bills. Money is shared trust you can carry. That sounds simple. It is not. Imagine a world without money. You bake bread and want shoes. The shoemaker does not need bread today. Maybe she needs firewood. So now you have to find a woodcutter who wants bread, trade for wood, return for the shoes, and hope nobody changes their mind in between. Life becomes a giant puzzle. Money removes that puzzle. It gives everyone a common middle step. You trade your work for money. You trade money for what you need. Simple, but only if money does three things well. First, people have to accept it. Second, it has to help compare value. A loaf of bread, an hour of labor, a bicycle repair, and a winter coat all need a common language. Third, it has to hold value long enough for you to use it later. That is why almost anything can become money if enough people agree. Shells, salt, silver, gold, paper, numbers on a screen. Gold worked because it was rare, durable, and hard to fake. Paper worked because it was easier to carry. Bank accounts worked because carrying numbers is easier still. Today, most money is not physical at all. It is records inside banking systems.
Your salary arrives as digits. Your rent leaves as digits. The money feels real because the system around it is real enough to keep the promise. And that word, promise, is the part most people miss. When you get paid, your employer is translating your time and skill into a number. When you buy groceries, you translate that number back into food. When a bank gives a loan, it brings future money into the present. When a government creates more money, it changes how much each unit of that promise is worth. This is not just theory. It happens every single day, and you feel it. You feel it when your favorite cafe raises the price of a coffee by 50 cents. Small on the menu, significant over a month. You feel it when rent rises faster than your salary, so the apartment stays the same but takes a bigger bite out of your life. You feel it when your grandparents say a coin once bought lunch, and now it barely buys a piece of gum. In each case, the object did not become more special. The relationship changed between money and what money can claim. History makes that clearer and harsher. Ancient rulers sometimes mixed cheaper metals into coins while pretending they were still full value. The coin looked familiar. The trust inside it had been quietly watered down. People eventually noticed. Prices rose. Confidence fell. Trade became harder. The shape of the money remained. The meaning of the money weakened. In the early 1920s, Germany experienced hyperinflation so severe that wages had to be paid daily and people rushed to spend them within hours before the money lost more value by the afternoon. The paper still existed. The promise inside it was melting by the hour. Money stopped being a bridge between today and tomorrow because tomorrow arrived too fast. Argentina in 2023 and 2024 told the same story in a different language. Prices rose so quickly that holding cash felt like watching water drain from a glass. The numbers in bank accounts still existed. What those numbers could actually buy kept shrinking. Different country, same lesson. Money only works when the promise holds. Not every price increase means the promise is breaking. Sometimes prices rise because too much money is chasing too few goods.
Sometimes prices rise because real goods become scarce, a drought, a broken supply chain, a disrupted oil supply that makes transport more expensive, and suddenly that cost spreads through food, manufacturing, and shipping. Different causes, same feeling at the checkout. At the core, the same thing happens. Money buys less because the balance between money and real things shifts. That is why modern money needs management. Central banks try to protect that trust.
They keep prices more stable, support employment, and stop the financial system from panicking. They raise interest rates to make borrowing more expensive, which usually slows spending and cools inflation. They lower rates to encourage growth when the economy is weak. Banks sit in the middle of this system like giant translators of trust. They take deposits, make loans, and this surprises most people, they create money through credit. When a bank lends, it is not always moving existing cash from one box to another. It is often expanding the pool of spendable money. That can be useful. Businesses grow, families buy homes, economies develop. But it also means money is tied to debt. A lot of modern money exists because someone, somewhere, owes something. And that changes how you should think about your own life. Money is not wealth. It is a claim on wealth. A higher number in your account does not automatically mean you are safer if prices are rising faster than that number grows. Earning more matters, but what your income can actually buy matters more. Saving matters, but what you save in matters too. Debt can move you forward, but it pulls future claims into the present, so it has to be handled carefully. Once you understand money as a claim, not the thing itself, you stop staring only at the number. You start watching purchasing power, stability, and choices. Cash is useful for flexibility and safety in the short term. Over long periods, if prices keep rising, idle cash quietly shrinks in real terms, not in the account, but in what it can do. That does not make cash bad. It means every form of money has a job, and every job has limits. In the end, money is one of humanity's most powerful inventions because it lets strangers cooperate at enormous scale. It turns effort into exchange, exchange into specialization, and specialization into modern life. But it only works when the trust stays intact. The next time you hear that little beep at the checkout, remember what just happened. You were not just spending, you were participating in a giant agreement that connects farms, factories, trucks, banks, governments, and millions of people who will never meet you. That is what money really is, a portable promise built on shared belief. And once you understand that promise, you stop treating money like a number and start treating it like power. Power over time, power over choices, power over the future you are building. Where in your life have you quietly noticed money buying less? Maybe it's groceries, maybe it's rent, maybe it's something small you did not expect. Drop it in the comments. I read every one. And if this changed how you see money, subscribe. There's a lot more to understand.